Meet Ryan. Ryan is 32 years old, makes $85,000 a year, and is doing everything right. He's maxing out his 401k, contributing $23,000 a year, and he even hired a financial advisor because he's the kind of person who reads personal finance articles at 11 p.m. and feels good about himself afterward. Ryan drives a sensible car, packs lunch 3 days a week, and has a Vanguard sticker on his water bottle that he doesn't fully understand but likes the energy of. Ryan's advisor charges him a 2% annual management fee, which sounds perfectly reasonable. It's 2 cents on the dollar. The advisor wears a nice suit, has a framed degree on the wall, and uses phrases like risk-adjusted return profile with the kind of confidence that makes you feel like you're in good hands. Ryan is not in good hands. Betes. Ryan is being quietly drained of roughly $500,000 over the course of his working life, and nobody in that office with the nice furniture and the free coffee is going to bring that up. Because here's the thing about the financial services industry. It's the only place on earth where the person selling you the product isn't legally required to act in your best interest. And yet, roughly 80 million Americans have handed their savings over to it anyway. So today, we're going to talk about the mechanism, the legal framework that makes this possible, the math that makes it devastating, and why the people who are supposed to protect you from this have largely done nothing. Because once you see this clearly, you won't be able to unsee it. Let's start with the part that sounds boring but is actually infuriating. There are two types of financial advisors in the United States. There are fiduciaries, and there are brokers operating under something called the Suitability standard. And the difference between these two things is the difference between someone who works for you and someone who works for their commission check while pretending to work for you. A fiduciary is legally obligated to act in your best interest. Full stop. If a fiduciary recommends an investment that earns them a higher commission but isn't the best option for you, they can be held legally liable. Sounds reasonable, right? Sounds like the bare minimum you'd expect from someone managing your entire financial future. Great. Here's the gut punch. Only about 15% of financial advisors in the United States are actually held to a fiduciary standard at all times. The other 85% operate under the suitability standard. And the suitability standard says an advisor only has to recommend products that are suitable for you, not optimal, not the best available, just suitable. Suitable is the financial equivalent of technically edible. It doesn't mean good. It doesn't mean in your interest. It just means it won't immediately kill you. And under that standard, an advisor can legally steer you into a mutual fund with a 1.5% expense ratio, when an almost identical index fund exists with a 0.03% expense ratio, as long as the higher fee product clears the very low bar of being suitable for your situation. And here's where this goes from annoying to borderline criminal. Those fees compound. Just like your investments compound over time, fees compound against you over time. And this is the mechanism most people fundamentally misunderstand, because they hear 2% and think it's 2%. It is not 2%. It is far, far worse than 2%. Here's the actual math, and I want you to sit with this for a second. Let's take Ryan. He starts investing at 32, puts in $23,000 a year, earns an average 8% annual return over 33 years, and retires at 65. With zero fees, Ryan's portfolio is worth approximately $3.2 million. Not bad. Ryan is comfortable. Ryan buys a boat. Nothing crazy, but a boat. Now add a 2% annual management fee. That 8% return becomes a net 6% return after fees every single year. Run the same numbers, same contributions, same 33 years, net 6% instead of 8%. Ryan's portfolio is now worth approximately $2.1 million. The fee cost Ryan $1.1 million. Not $500,000 like I said in the title. Over $1 million. I lowballed it for the thumbnail. And the darkest part of this math isn't even the number. It's what that 2% fee actually represents in real terms. In Ryan's first year, when his portfolio is small, 2% is almost nothing. Maybe $500 bucks, whatever. But by year 30, when Ryan's portfolio has grown to over $1 million, that same 2% fee is now $20,000 or $25,000 a year, every single year, being quietly skimmed from the top. The fee grows proportionally with the wealth it's supposed to be protecting. It is the most elegant design flaw in the history of personal finance. And you'd assume, logically, that this fee comes with some kind of superior result. Because you're paying a professional with a framed degree, and a coffee machine in the lobby. Surely the performance justifies the cost. It does not. This is where the data becomes genuinely hard to look at. S&P Global publishes an annual report called the SPIVA scorecard, which tracks how actively managed funds perform versus their benchmark index over time. And the results are not a close call. Over a 15-year period, roughly 92% of large-cap actively managed funds in the United States underperformed the S&P 500. Not some of them, not most of them, 92%. And that number gets worse the longer the time horizon. Over 20 years, it approaches 95%. So you're paying a 2% fee for an 8 to 10% chance of beating an index fund that charges you 0.03%. And the people selling you the underperforming product are legally allowed to do it, ethically comfortable doing it, and financially incentivized to keep doing it forever. Now let's talk about why this is so deeply baked in. Because this didn't happen by accident. The story starts in 1974 with the Employee Retirement Income Security Act, better known as ERISA. ERISA was created to protect the retirement savings of American workers, and by most historical accounts, it was genuinely well-intentioned. It created the legal framework for employer-sponsored retirement plans, set minimum standards for plan management, and gave workers protections they'd never had before. The 401k as we know it didn't exist yet, but ERISA laid the groundwork, and then the financial industry spent the next 50 years quietly colonizing that groundwork. Because what ERISA also did, unintentionally, was create an enormous captive market. Tens of millions of workers who were automatically funneled into employer-sponsored retirement plans, most of which offered a pre-selected menu of investment options. Options that were often chosen not by independent experts with your best interest at heart, but by relationships between plan administrators and fund companies. Fund companies that paid for shelf space the same way cereal brands pay to be at eye level in the grocery store. By the mid-2000s, the average 401k plan offered somewhere between 13 and 18 investment options, and studies found that most workers, presented with that many choices, simply defaulted to whatever was in the middle of the list or whatever sounded familiar. The fund industry understood this, and it was beautiful for them, because the funds on those menus weren't always the cheapest or the best performing. They were the ones whose companies had the most established distribution relationships. And here's the number that ties all of this together. The mutual fund industry in the United States manages approximately $27 trillion in assets, at an average expense ratio of somewhere around 0.5% to 1% annually across all funds. You are looking at between $135 billion and $270 billion in fees extracted from American investors every single year, just in management costs, before advisor fees, before trading costs, before the 12 B1 marketing fees that funds charge you to pay for the advertising that convinced you to buy the fund in the first place. Yes, that's a real thing. You are literally funding the commercials designed to trick you into buying the product you already bought. And the fund companies will tell you this is fair. They'll tell you active management adds value, but that their research teams and analysts and portfolio managers justify the cost. And maybe, in isolated cases, they do. But the SPIVA data doesn't lie. And 92% of them, over a 15-year window, don't. Now here's the part that I think is the most uncomfortable, and also the most important. None of this is technically illegal. That's the part people can't wrap their heads around. When you lay it all out like this, the misaligned incentives, the suitability standard loophole, the fee compounding, the captive retirement market, the underperformance numbers, it sounds like a coordinated heist. But it's not a heist. It's just a system that was designed by people who benefit from it, regulated by people who were lobbied by those same people, and largely ignored by the customers. It quietly grinds down over decades. Because this is how it works. You don't notice a 2% fee the same way you don't notice your car slowly rusting. It's not dramatic. There's no moment where your account gets visibly robbed. It just grows a little more slowly, year after year, and nobody sends you a letter that says, hey, this year's fees cost you $18,000, which is more than you spent on groceries. Because that letter would be bad for business. And by the time most people figure this out, they're in their 50s. The compounding math has already played out, and the window to recover it is closing fast. So here's what you can actually do, and I know people hate the practical section because it sounds like homework, but stay with me because this is the part worth writing down. Number 1, Find out if your financial advisor is a fiduciary. Not sometimes, not in certain accounts, all the time in writing. If they're not, that is the only information you need about whose interests they're prioritizing. Number 2, look up every single fund in your 401k or brokerage account and check the expense ratio. You can find it on any fund's prospectus or on Morningstar for free. If you're holding a fund with an expense ratio above 0.5%, ask yourself what you're getting for that. The answer in most cases is statistically slightly worse performance than a $27 a year Vanguard index fund. Number 3, understand the difference between an expense ratio and an advisory fee. Both are real costs, both compound, both matter, and most people who have a financial advisor are paying both simultaneously on the same money every single year. Number 4, look up the SPIVA scorecard, not because you need to become a finance expert, but because seeing the data for yourself in black and white is genuinely the fastest way to understand why this conversation matters. Number 5, the single most statistically supported investment decision an average person can make, according to decades of data, is to hold low-cost, diversified index funds consistently over time. That's it. That's the whole strategy. And the fact that a $27 trillion industry has spent 50 years trying to convince you that it's more complicated than that should tell you everything you need to know. And look, I'm not saying every financial advisor is a villain. Some of them are genuinely excellent, fiduciary certified, and earn every dollar of what they charge. They exist. But they are not the default. The default, when you walk into a financial services firm without asking the right questions, but is a commission-based broker operating under a legal standard specifically designed to protect them, not you. And the worst part? You probably already know someone in their 50s or 60s who worked their whole life, did everything they were supposed to do, contributed faithfully to their 401k for 30 years, and still ended up with a retirement that's tighter than it should have been. And it probably never even occurred to them that a 1.5% fee on a $400,000 portfolio was costing them $6,000 a year, every year, for 3 decades. Because the industry has done a magnificent job of making fees feel small, making the math feel complicated, and making the whole subject feel too boring to dig into, which is, of course, entirely by design. Because confusion and apathy are worth hundreds of billions of dollars a year to the people selling you this stuff. Ryan deserves to know this. And so does everyone who hands their savings over to someone in a nice suit without asking the one question that actually matters. Whose side are you legally on? So I want to know where you land. Drop your take in the comments because I read them. Are you A, actively managing your own investments and avoiding advisors entirely? B, paying an advisor but now reconsidering whether they're actually worth the fee? Or C, completely numb to this and planning to just put everything in an S&P 500 index fund and never think about it again? Genuinely curious how split people are on this, because the comments on this one are going to be interesting.